Hi, everyone. Welcome to our first show of Reinventing Finance. I'm really excited to be able to co-host this show with Tom. And before we introduce our first guest, who we're also really excited about, Tom, why don't you briefly introduce yourself and why you decided to do the show with me?
Yeah, thank you, Nick. My name is Tom van der Lubbe. I'm Dutch, living in
It's okay.
Zurich, living in Zurich, and I'm an entrepreneur in the finance space, active in the Netherlands with mortgage advice called Visie, and active in this financial space, so to say, since mid 90s. Just as a very short introduction.
Thank you, Tom. So, and my name is Nick. I'm CEO and co-founder of Casco. I'm German, but as you can see, it's okay for us both ways. I actually started this show because out of personal interest, I wanted to talk through with the change makers in the industry, ask them some questions that were kind of on my mind, and got a partner in crime with Tom. So here we are. But without further ado, we're also very happy, Ollie, to welcome you to the show. Ollie, I think you can introduce yourself much better than I ever could. So why don't you tell us a little bit about yourself, who you are, and what your company does?
Sure. Thanks for having me, guys. And I know both of you or have known you for a very long time. I'm also German like Nick, but I'm living in Zurich like Tom. So Tom and I have met in Zurich for a long time, actually, a couple of times a year. We have nice lunches at the lake in summer, typically. So yes, I'm Ollie. I'm currently the CEO for One Insurance, which has been renamed this week into wefox Insurance. So we're now called wefox. Yes, news of the day. So we're now called wefox Insurance. I'm also responsible in the wefox group, which is a bit broader, as some of you might know, for the distribution since about a year. So we basically reorganize and bring together not just the name, but also the operations of our distribution wefox and the insurance wefox. So that's what I'm doing currently. Before that, I've been a consultant. I started in McKinsey, like Tom has, and been a risk officer at Converium and Score reinsurance companies. I've been a broker for many years, like Nick, you and your dad, and an entrepreneur. I've co-founded quite a couple of insure techs, or whatever we call this. So tech companies that are in the insurance space, or insurance companies that are techie. So a lot of industry know-how. I don't know how to build cars. I don't know how to sell clothes. I'm an industry geek.
Ollie, thank you so much. I actually have, and thanks for kind of sharing the news. And I wanted to, that you mentioned it, that, as CEO of One, you're responsible for the product, right? Now, wefox being, a very strong distribution play, now also being responsible for distribution. Actually, I find that the functional split, especially between product distribution and, in that case, normally IT, that some companies start reorganizing that a little bit, because in a digital world, these things tie in together much more than traditionally. Is that also one of the reasons why you guys did it, or what was the reason for kind of bringing this closer together, so you can basically make the trade-offs, holistically?
Absolutely, and honestly, I don't understand why we have separated this at the very beginning in the first place, right? I mean, it was probably a dumb idea to separate this from the very beginning. So we should have brought this or kept this together from the very beginning, but we didn't. So that was a mistake in hindsight. We're correcting the mistake, and we're bringing it all together, because you're right. Insurance from end to end is a digital product. Consulting, advising is digital. Basically, it's a number of if-then questions that we as brokers, and we are brokers, right? We as brokers ask our customers, and depending on the answers to the if questions, there's a solution, right? Best product for you is Allianz Life or VHV car or whatever, right? So that's typically what machines do best. And same with products. Obviously, it's all digital. It's flow of information and money in terms of premiums and claims. But there's nothing physical in the product. So yes, everything is digital, or can be digital, should be digital. And so yes, we need to look at it end to end, and therefore I mean, you mentioned the term product. I just come out of a discussion with a established insurer's CEO or C-level, actually, it was a C-level meeting where we discussed the importance of the product department. And for them, product is actuarial and maybe a bit underwriting or so. And for us, product is the central department of the company, right? They do everything. I mean, when we think product, it's end to end. So if we think insurance product, it's not only the tariff, calculated and legal with legal terms. It's the thing is finished when the tariff is on the API. Yeah. So that's when product is finished with an insurance product. But product is further. Product is much more with us. Product is also the broker portal that our brokers, our distribution, our agents use, right? Broker portal is what we call the ops workbenches. So that's where our customer support and our claim support work on. So this is all product. Product is the most central and probably one of the largest departments we have in one wefox or wefox now. And this is much different from what everybody else tells me of the incumbents.
I think this is really interesting because I also find in our discussions that it's first really important to define product, because with using the same terminology but thinking about it in very different terms, right? And in order to create that understanding, and I would even now with a very much advisory driven flow where you could theoretically, if you're controlling it, ask more questions than, as many questions as you think are required to calculate the product. But, that's not really true. If you're deploying your products in someone else's aggregation, then they'll define the relevant set. So you probably should, by designing your insurance product, be aware about the kind of questions or the contextual information, we're certainly going to go into that are relevant at different touch points. And so disconnecting these things just ensures, non-optimal performance down the line. I mean, it's as simple as that.
Couldn't agree more. Couldn't agree more. And what's also relevant is if you put yourself into the position of the advisors, and I think we're probably going to touch on that, and we fundamentally believe that people should get advice before buying insurance. But if you put yourself into those shoes, and I've put myself into those shoes because I was a broker for 12 years, you know how painful it is to go through all those questionnaires, even if you have the standardized applications, Einheitsantrag, as we say in German, for many insurance companies, it's still a pain in the butt. Just going through the Check24 motor insurance questionnaire, containing all the questions of all the insurance companies behind Check24 means answering 60 or more questions. So it's a pain in the butt. And if you think about making that easier for sales or the advisors, you think about where can I get this information from elsewhere, instead of having an advisor asking a customer, because most of this information is out there. I mean, what questions do I answer when I buy a motor contract on Check24? Do I have a garage? Somebody knows that information is out there. Am I living do I own my house or rent my house? How old am I? Where am I living? What's the car? I mean, this information is out there, right? Mm-hmm. I mean, go to the databases where you can find this, instead of forcing an agent and an advisor to ask a customer. That's a painful process.
And I think that's an interesting point that you'll say, can you, do you really need to dumb down your risk model so that, and not dumb down in the sense of that it's a dumb process, so that it's just humanly manageable. And by aggregating certain data sources, you can augment underwriting, you can create proxies. And I think that is a whole different story. Just one, from your opinion, because I thought when you said price comparison sites, and their promise is, I'm going to compare the market. Now, in my experience, and I have not been a retail broker, so I come from commercial brokerage, and in the family business, we did an MGA business for classic cars. So what I've learned during that time is comparing is a little bit for dummies. The real game is being made by getting a panel of insurers, creating a better product for your target audience. And if you give choice, right? But no one needs 80 insurance companies on your product. You maybe need 3 or 5, depending. Is that a trend you see as well, especially with the aggregation of brokerage and advisors that you could also streamline the product by limiting, but thus also making it interesting of a panel of insurers rather than comparing the market?
Cool. That's several questions in one. So
Sorry.
I would probably disagree with aggregators being an old-fashioned or dumb business model. I mean, it's a business model for a specific segment. And yes, I think they could be more honest to the customer in saying, look, guys, what we do is the following. We connect very price-sensitive customers with insurance companies that haven't met their revenue targets, right? That's basically what it is. And where the CEO starts to panic and starts offering his or her tariffs at a very low price, typically below the technical price. That's all they do. And they should be as honest to us as saying, this is what we do. You know, some poor CEO always panics because he or she hasn't met their targets yet and gets pushed by the board of directors or the shareholders or whatever. And we just match those with very price sensitive customers. That's a fair game. And that's a sizable segment to serve on both sides. So I see that surviving. I think we could be more honest and not claim we compare the entire market for you and do something good for you. No, you're very price sensitive. We found the idiot who needs to offer below technical price to hit the revenue targets. We match you, and that's it. So that's a fair model, right? Do I think that technology and bringing the insurance product back to the digital space instead of filling out papers and doing everything manually allows us to differentiate the product to better serve very specific target and customer groups? Yes, I do. And that's what's happening. That's what you did in your OCC, and that's what many other persons do. It is somewhat driven by brokers and MGAs because they don't have the legacy of the old systems. And you do need modern technology to do it because with the old ancient technology, you just need a couple of 100,000 of tariffs in order to make up for the fixed cost that it means in the old technology to bring out a new tariff. So it is for the new players, basically, the new neo insurers or the MGAs to do it. But yes, I do think that technology allows us to define and create much more targeted products which are less one size fits all because I need 1 million tariffs to get back my fixed cost.
Yep.
Just to come more to, let's say, the whole landscape. On the one hand, Germany, which is your main market, and then perhaps afterwards also from an international perspective, which parties do you see as main competitors, or perhaps also in the future, because we also just mentioned Check 24 as an example, but also let's say the new players in the space, the insurtech companies or the incumbents, etc. What's your opinion on that?
That's also not so easy to answer, Tom. As a company, wefox, we basically have two beliefs. Number one, we do, as I said, we do think that the vast majority of people on the earth should get advice before buying insurance. We do believe that only a very small minority, probably 5% or less of all people, should go out there, inform themselves about insurance, and then buy online or buy direct, right? So we're a strong believer in advice. At the same time, we are a strong believer in digitization. So we do think that end to end, as Nick said, we can make insurance a fully digital product. We think that eventually, at some point in time, I'm probably not gonna live as long, but eventually insurance should be an industry that could be administered without any human person, because it's all if then, right? It can be done by machines if we just train them well enough. So these are our two fundamental beliefs. In terms of the first belief, everybody who provides good advice digitally is a competitor, right? So I mean, if we look in Germany, if we look at Clark, for example, who try to bring advice to the digital space, that's a good movement, right? That's I mean, that's obviously not there yet, but that's a good movement. So we would consider that a competitor. There's a couple of those businesses in the US that try to make advice digital, and from starting to support the human advisor towards I can make the entire journey digital. I can make it an Amazon skill or so, right? So all players in this field are potentially competitors. Focus on insurance advice and make this digital. And then obviously there's the neo insurers, as you mentioned, Tom, who mostly, unfortunately, and from our perspective, focus on the digital sale. So it seems to be a rule that you can only be a digital neo insurer if you sell direct, right? So if you build your own brand, your own customers like Lemonade, Root, Metromile. So we don't believe in that rule. And so in the sense that those guys are fairly digital, probably not quite as digital as we are, but fairly digital. Those obviously are a competitor in the sense of how fast do we make this 100% digital? And that's a race, right? And obviously, we are at about 80% straight through process ratio. Other neo insurers are probably between 50 and 70. And then the typical incumbents are between 10 and 20. And that's a race towards the 100. And every step gets harder and harder and harder, right? The closer you are to the 100, the harder the next step is. So I would consider them, everybody who's above 50 or 60% straight through process ratio, I would consider competitor as well.
Okay, just to add a question on this, as we are an international podcast, your colleague Julian Tijke likes to post comparisons between one wefox on the one hand and Lemonade on the other side. Could you tell something about this? For instance, acquisition costs, etc. Because probably the Lemonade CEO will also be one of our future guests. Would be interesting to have your comments on that.
Good one. I mean, Lemonade is doing an awesome job. Daniel and his team are doing an awesome job. It's very hard to compare us because, as I said, Lemonade is in the space of creating their own brand, which they do great, creating their own customers, which they own without any intermediary between them. And we're different, right? We sell through advisors. So we always co-own the customer. At least once it's in an external advisor. If it's a wefox advisor, obviously wefox owns the entire customer relationship. But I mean, the nature of the business and the amount of ownership of the customer is so different between what Daniel does and what we do that it's very hard to compare. And you shouldn't compare just one side of it. Obviously, Lemonade has very high customer acquisition costs upfront, but then doesn't pay anything for the customer anymore, and they can play with the customer, cross-sell to the customer as much as they want. One, on the other hand, or wefox, does not have this high customer acquisition costs. We typically pay a portion of our revenues to our advisors, to our sales partners, which basically make us work on a zero CAC, if you want, except a couple of marketing costs, which are not very high. But obviously make us less profitable the longer the customer relationship lasts, right? So there's a break even where clearly the Lemonade model is more profitable than the one model. That break even is far out, and Lemonade has not yet come to prove that they can keep the customer as long as hitting the break even point on average. But I mean, the model is so different that the comparison is almost unfair. I mean, you need to look at it from a very holistic perspective, and there's no clear winner or loser. If we hit the break-even point, then Lemonade is more profitable than one at the end of the day.
I think. Okay, but sorry, go ahead, Tom.
Could be a good bridge to your one policy, because your one policy could solve let's say, the problem you just described.
Well, it could solve our problem, but not Lemonade's problem.
Your.
I mean, our problem is not that the missing customer loyalty. I mean, that's a good thing about the channels we sell through. The customers our advisors bring to us are fairly loyal. So we're talking, 10 years plus, depending on the product, motor shorter, obviously, but household liability, 10 years plus on average customer lifetime. So the problem is more on the direct side. So Lemonade, Root, Metromile, all those guys, Alan, they have a problem of customer loyalty because the customer segment that buys insurance direct online is typically a customer segment that doesn't stop that next year. So they keep shopping. right? And if you see the next nice handbag, then you buy the next nice handbag, and you forget your previous handbag. So if you find the next best insurance online, you buy this and you leave lemonade. So the one of the issues, I guess, and I don't want to interfere with Danny and his team, but one problem is that the inherent choice of customer segment, right? It is a direct segment. It's good, I think, but it has this low loyalty baked into it, basically, right? That's basically what you buy. It's the same with aggregators. You buy the customer that looks for price and not for service, right? I mean, it's just a choice that you've made. And with the high CAC that they have, they need high loyalty, but the segment they serve is providing or is proving low loyalty. So I think this is the catch-22 that those guys will have to solve. It's not our catch-22 because we don't have CACs, right? I mean, our customers, basically, I don't care how long a customer stays with me because I pay X% of my premium volume to anybody who brings a customer to me. If that's new customers every year, or if that's the same customers every year, doesn't change my math. So I don't have the loyalty problem, which is good on one side, but which kind of limits the upside with high customer loyalty. But yes, I mean, with the one policy, like the all risk policy that covers your entire life and grows with you, that obviously will be a product with very high customer loyalty, because why would you change if your insurance grows with you and adjusts to your life and covers everything in your life? There wouldn't be a need to change anymore. So I think it would be a very good product for the direct insurers to increase their customer loyalty, which probably today is too low to make their business work.
I think it was interesting when I listened to you, Ollie. I was thinking Hook Coburg, the German kind of powerhouse who owns their own distribution. I thought, it's actually similar. But I think the key point is most of their customer base obviously didn't come from digital channels. They still owned the customer. And if you're kind of looking what a owned, not ongoing commission-based model with a higher upfront cost and lower means after 10 years successfully and how much recurring it's crazy what, it's really hard to outcompete with them on a blended base, but they didn't acquire low loyalty customers. I think they acquired even more loyal customers with their distribution model. And it clicked, I thought for me, it clicked really well to kind of say direct, higher customer acquisition costs, and you basically betting on the churn or the lower churn, but it's a high velocity bet because you're targeting high turnover customers by definition a little bit. From your points, I had a couple of questions actually to what you've said, and I just kind of wanted to dig into each one. So you said wefox believes get advice before buying insurance.
Mm-hmm.
Why is that?
Because you can make a lot of mistakes when buying insurance, and worst case is this mistakes can cost your life or can at least cost your the life as you know it, right? So even a simple, I mean, we have this weird thing in the industry, differentiating simple products from complex products. And I don't know where that comes from, actually. If I ask my mom, she's 80, if she thinks a life insurance is more or less complex than a household or private liability insurance, she says, that's all complex. I don't understand a thing this does, right? So I think it's an industry-driven definition. I don't know who came up with it, probably a smart consultant came up with it. So we tell ourselves and our customers that you should buy simple products online and without advice, but the complex products you should buy with advice. Now, what makes a private liability insurance non-complex, right? I mean, there's so many cases, and I mean, we've both been brokers, Nick. So there's so many cases that you can tell a customer why it's important to look for the right coverage in private liability. What about the 3 ladies that burnt down the ape thing in the zoo in, I think it was Wuppertal or so, I think it was New Year's 2019, or I don't know exactly when it was. 15 million damage, right? Who has a private liability insurance with 15 million maximum coverage? Or the guy that had his drone fly over London Gatwick, right? 60 million pounds damage. Who has a private liability policy with 60 million pounds maximum damage coverage, right? I mean, these are things you don't find in the internet on page 1 in Google when you look for private liability insurance. So that's why we say you need advice. Even in the so-called simple product, you can make so many mistakes that cost your career. I mean, what is with the guy in London, right? I mean, he's now, he owes the London Gatwick Airport 60 million pounds. That basically is it, right? I mean, now you have in Great Britain, you have different private insolvency laws than in Germany, but in Germany would mean 7 years of minimum wage. The rest will be taken from you and given to the airport. So 7 years of not being able to properly feed your family, not being able to buy a house or a proper car. I mean, that's what it means if you buy a wrong, simple product, private liability. Everybody thinks it's simple. It's only 3 questions to ask in order to sell it. But we think it needs advice. I mean, people are doing the wrong stuff if they don't seek advice on it.
And so I would say, I think because and I think it's true that for most, you don't interact with insurance purchases that frequently in your life. So there is a baked-in information asymmetry, and thus having an expert that you can trust, and then we can discuss whether certain incentives are more trustworthy than others. But as a definition, it seems like that there's a strong tendency towards expert advice, simply because it is very hard for you to cost effectively and at scale kind of figure out this stuff, right?
Absolutely. And second part, insurance is probably the only one of few products. I can't think of anything else, but there's probably other things. Insurance is one of the very few products where you can lose more than the purchase price, right? If you buy a used car and that breaks down the next day, all you lose is 5,000 euro on the used car, right? That's all you lose.
You know your bet.
You know your bet. You know the maximum bet. In insurance, you buy a private liability for 50 euro, but you owe London Gatwick 60 million pounds, right? So, I mean, here's the thing. It's horrendously dangerous to buy the wrong thing. You lose much more than just the 5,000, which is hard enough to lose 5,000 on a broken used car. But I mean, we should protect you. You should protect yourself from a wrong decision in insurance, because it can cost your life. I mean, in the US, if you're not covered, if your health insurance doesn't cover certain sicknesses, certain illnesses, you die. I mean, hospitals won't take you and you won't be able to buy, to purchase it, right, yourself. So you'll die. I mean, this is your life you were talking about. You purchase the wrong piece of private health insurance in the US, you die. Yeah. I mean, this is how dangerous it is.
Thank you very much. I thought that was, and I specifically really like the analogy that for most other purchases, you know the maximum drawdown, and insurance just works differently. And I actually never thought about it in that defined terms, and I thought that was that kind of made click in my mind. Thank you very much, Ollie. I wanted to do this to learn, and this is at least one takeaway. There's quite a few others. So there was a second thing you mentioned, and you said you have 2 types of competitors. One is anyone providing digital advice. I'm not going to name anyone who's doing a good job out of Frankfurt here. And you talked about neo-insurers, and I just wanted to challenge one of the statements that you've made. And you said most of them go into digital sales. I would challenge it to the premise, I think in the US, spot on, and that's the big ones. In Germany or in Europe, let's say, Germany, UK, France, they have different plays, but I would actually argue that a lot of, let's say, Germany, which has a lot of full stacks, you see a move towards embedded insurance, B2B2C, quite a lot, and actually others either going to power brokers or even trying to become an outsourcing partner to insurance carriers. Now, in truth, some of the stories are actually a lot of these neo-insurers, they seem to be stacking up VC money, actually looking of, where the big, if you were to take out the VC money out of some digital platforms and MGA insurtechs, I think it would be quite interesting how some of the gross written premiums would really look like if you're kind of looking behind the curtain. But my point is more, would you say that statement is also true for Germany, that it's full stack insurers go direct to consumer most of the time?
Still, most of them do. I mean, neo-digital is an exception, and that's the reason they are the second most successful new insurer in Germany. But if you look at Koya, Friday, Nexable, Adam Riese, they all go direct, and Lemonade goes direct in Europe as well. Now there's a turning point where all of these guys realize that it's really, really hard and expensive to get to customers, and then some of them turn to brokers or to other sales partners. But as we and Stephen Voss will probably tell you the same thing, if you build yourself as a insurer for advisors, the setup is so different that you can't just, as a Lemonade or as a Koya, go to an advisor and say, hey, I've built myself as a direct insurer, but it doesn't work for me in Europe. So can you sell my stuff? I mean, this doesn't work. I mean, the services, and you know that probably better than I do, the services behind a broker insurer are so different from a direct insurer that it's not just, hey, here are my products. They don't work direct. So dear broker, please, can you sell it? This doesn't work. I know that Lemonade is doing it. I know that other names that we've just mentioned do it, but it doesn't work. So I think, and Stephen will tell you the same thing, you need to set yourself up as a B2B2C advisor insurer, because as you said in the very beginning, it's about making the lives of your advisors easy, right? I mean, what questions do they need to ask to the customers? That's the thing you think about. Where can you get the information from except from the customer? That's the things and then all the follow-up processes that as a direct insurer, you only have the processes, Geschäftsvorfälle, which concern the customer. As a broker insurer, you have a whole lot of new Geschäftsvorfälle processes that are relevant for the broker only, right? The broker asks for, when is my commission coming? The broker asks for, how much commission do I get next month? The broker asks for, can you please put together a portfolio of customers that I brought to you? I mean, there's so many Geschäftsvorfälle from a broker that are so different from what a customer, an end customer will ask or would ask. I mean, there's a whole lot of new processes you need to optimize and digitize, and those guys are nowhere. So, I mean, it's not just, hey, here are the products, can you sell them as a broker? I mean, this won't work.
Thank you. Now, I think that's, I mean, you can, it's basically the old adage, you can do anything, you just can't do everything, right?
Yes.
And that is just true in business as well. Sorry, Tom, you wanted to.
Yeah, I'm curious, what will you expect, what will happen, for instance, with the Lemonade in the German market in the next 5 or 10 years?
That's a good question, Tom. I mean, what we see is the segment of customers who buy insurance direct is small, probably still too large from my perspective. I think more customers should do so buy insurance direct, but it's about 10%, depending on the line of business. It's more or less, but it's about 10%. We don't see that growing. We don't see it growing in the US. We don't see it growing in Europe, except for the UK. We've given themselves a specific regulation that drives direct sales. We also see it in the Netherlands, but in no other country in Europe. Different markets, different regulation. We don't see it in China, by the way. I mean, we see shitloads of advisors in China. I mean, Ping An has 1 million, I think. We don't see direct sales going through the roof, right? So I think the segment is a bit larger than it should be from my perspective, from a total perspective, but it is where it is, about around 10%. So they're targeting a small segment wherever they are. Is this segment growing? I think that's their bet. That's the bet of Lemonade and many others, that after many, many years where it should have grown, and when I was telling insurance companies when I still was a consultant back in the early 2000s that, hey, this will come, I mean, the direct segment will grow like hell. And it was 8% then, and now 20 years later, it's 10%, right? So it's anything but an explosion. I personally think it will not explode, and it should not explode in the future. Lemonade and Koya and others probably think it will explode. Not sure who's winning that bet, so to say. So they're focusing on a small segment of their. I think what they do is very good, but a lot of people are pouring into that segment. I mean, Hook24 in Germany is doing a great job, and they're not giving up on it. The aggregators are kind of addressing the same or similar segment. So there's a lot of competition for a small, not growing segment. Can this be successful? Yes, it can. I mean, Hook proves it. Geico proves it in the US. There's several insurances who prove that this can be a successful model. But will this scale the way the investors believe it, given the share price of Lemonade? I'm not sure, but I mean, I don't have a crystal ball. So that's it.
The one danger that I see, because everyone's kind of using the same channel, either a prevalent price comparison site or, you know, Google, Facebook, Instagram, and maybe TikTok, I don't know. So you can very quickly muscle in if you want to gain market share. And it is then a little bit a question who is willing to bleed longer and faster. And that just is an uncomfortable position, I feel, to be in. Whereas if you obviously have, you know, anyone knows, if it's a bit harder to get in, it's also much harder to get out. And it's, you know, having trusted business partners, especially in insurance, anyone knowing in brokerage, you'll see that, you know, these renewals, they come around in time. So it's actually very important having a trusted counterparty who doesn't kick you out because of 2 percentage points on a combined ratio. And which is, you know, why some, let's say, more flexible capacity from Anglo-Saxon countries have found it quite difficult to just breach into continental European markets who might have a more longer term view about that advisory relationship also. So I think one last point, and Tom also mentioned it to kind of say on the international front. Now, you guys started in Germany, you regulated in Liechtenstein, you entered Switzerland. I believe you have or will enter Poland. Was that correct? And
yes,
something about Italy, or was that more wefox? So please, if I'm not having taken well enough notes, let me know. But I guess my question is a little bit: how do you pick those markets? And how does your product, your approach, adjust based on a certain? I mean, and you can tell any secret. We'll tell it everyone else. So any secrets are highly welcome. But can you kind of walk us through that process, because you've just went through it as much as you know want to share, obviously.
Yeah, no, absolutely. I mean, the process of entering a new country for us is partially analytical and partially opportunistic, right? So obviously we have a wish list, and that has a priority of which countries to enter when. But as wefox, we need a strong advisory presence in each country to start with. At the very beginning, and that was a mistake, we tried to build that ourselves. So we tried to go into a market and build our advisory, our sales force from scratch, then enter with our insurance, which was called One and now it's called wefox Insurance, to basically use the sales power we've built and sell our own products. Now we've moved towards a buy and build approach. So we enter a country only once we have a target there, and the target always means a sales channel, an advisory channel. And we take over this target, grow it, and then bring our insurance in there and make them sell our own insurance products, which gives us a higher lifetime customer value than just selling third-party products, right? Because you only get the commission for third-party products, but you get the entire GWP minus claims and so on and it's much stickier for the insurance product. So this is the playbook. And so, as I said, there's a list of countries, but if we find a very cool takeover candidate in a country that's on position 3 on our list, we will move 3 upwards the list and make it 1, right?
So get it.
So that's the combination of you know, analytics and opportunistic.
And your inner consultant dies because we've scored them on 3, and you know you'll have to go through the list.
Yes, and we don't. We're pragmatic on this one. So what happened is, you know, we started in Switzerland with the advice. We built that from scratch. Then we purchased a company called SAM. It's now wefox Switzerland, and they are by now number 2 private customer advisor in Germany. Swiss Life Select is still number 1. We've probably become a larger player this year or beginning of next year, depending on how they grow and how we grow. But we will be number one in terms of private retail customer advisors in Switzerland next year. So that was step one. Now we bring our insurance products in there, and they start selling our motor products, our household liability, private liability product and stuff. So that's a typical way. In Germany, we had a distribution also built from scratch, later than Switzerland. We made a lot of mistakes in Germany. We never had a clear perspective in Germany, not so much as in Switzerland. We kind of changed between being a broker pool and a broker, and then back to the pool, and then something in between, a technology provider. So that was never really strong. So that's, and then in hindsight, it was probably the dumbest idea ever to start with one insurance in Germany, where we had the far weaker distribution channel or advisor channel than in Switzerland. And going to Liechtenstein, I mean, one of the main reasons we went to Liechtenstein as a regulated entity was that we could enter all EU countries plus Switzerland, right? And so here we are having one of the biggest, strongest distribution channels in Switzerland and a fairly weak distribution channel in Germany. And what are we idiots doing? We're going to Germany first, right? So I mean, in hindsight, you should probably punish us for that decision, but that's okay. That's down the drain. So Germany was different. We very quickly became the stronger parts of the company as an insurer by just using third-party brokers and not our own distribution channel, wefox, because it wasn't strong enough. So that's a bit different from the typical playbook. In Austria, we've also purchased a distribution called DMG, now wefox Austria. And we're now thinking about when to bring our products into Austria. In Poland, we actually didn't buy a distribution, but we have a strategic partnership with them. So that's why we went there as an insurance company. And in Italy, we're looking or about to find, I guess, a target to take over, a distribution target. And then we'll go there with our insurance products as well. So that's the playbook. Buy something, grow it, bring the insurance in there, and then grow together. That's basically the playbook. And except for Germany, where we just entered prematurely because the distribution side wasn't there yet, we actually follow that playbook.
And would you then say, because I think what's interesting is when you are venture backed, right? You need to have a pretty precise plan. You're selling your investors on a plan, and obviously along the journey you'll learn something, right? In your own experience, how difficult was it to convince investors who bought into a previous story to convince them on a new story? Is the question too generic to even give any insightful answer to that? But what would you advise be for someone else? And I guess the second thing is, what's the so what? Do you now stop being a pooler or a technology company also in Germany, or do you continuously use them as R&D for certain other things? So those two questions.
Okay, question number one. Interestingly, it was harder with our employees than with the investors. Okay. And I never bought into the investor story of, hey, we're investing in a team and not a business model. I always thought that was bullshit. But to be very fair with our investors, at least, and I can't tell anything about the rest of the world, but our investors clearly followed very quickly when we suggested a switch in the business model to them. So they clearly proved me wrong, and obviously invested into a team and not a concept or a business model. I'm not sure if that's true throughout the globe. I always thought it was a little bit of bullshitting, given how hard they look at the numbers of the business model and how few they look at the team. I always thought it was a bit of bullshitting, but I give credit to our investors. That was a fairly easy thing with them. It was harder for employees who saw themselves and defined themselves, let's say in Germany, for example, as a pooler, right? We don't do the dirty business of going from door to door and advising end customers. We're this sexy, cool technology provider, right? And for them, it was much harder than for our investors, to be honest. So the change management was more internally than with the investors. Giving credit, kudos to our investors, right? So second question, no, we're not a pooler anymore. We stopped that business. We won't be a pooler anymore. We're an advisor. We deal with end customers. We will turn into a B2C brand, hopefully a trusted brand of end customers trusting us to give them the right advice and the right products eventually. And yes, no, we stopped the pooler business. We're still a technology provider because we want to give advice as digital as possible. And I think technologically we are further advanced than the psychology of the majority of the customers. So I think we could give the customer a fully digital advice journey where a machine asks you those, I don't know, 100 questions to give you a 360 advice, DIN norm advice or so. But we feel that the vast majority of our customers doesn't want to talk to a machine yet, right? They still want a human person. Could be through video or telephone, but they want to talk to a human person. And so what we do is, for the moment, we enable our advisors to be as productive as possible, but we can't take them out of the equation yet, because the customer just doesn't want it yet, and we follow the customer. And we're not in a position to tell the customer, hey, you're an idiot. Why don't you accept the advice from a machine, right? That's the customer, and the customer tells us where we need to go. And the customer, the vast majority of the customer, 95% of the customers tell us we still want to talk to a machine. I think if you ask Clark, they will probably say the same thing. I mean, there's a couple of things they probably sell fully digital, and then there's the vast majority of their revenue is probably coming from manual advice, digitally supported towards the customer.
Yeah, I think that's true. I have so many more questions, but conscious of time, there is one particular question that I want to get your take on. Knowing what you've known, right? You know, you've say you were offered or you could take a job at one of the leading incumbent insurance companies as whatever, right? Whether that is CEO or, you know, a senior leadership position. I think what would maybe be the requirements, or what would you emphasize if you were to take that position? Let's say CEO, for, you know, knowing what you know right now, but also knowing that they have an existing business. Any kind of, what are your thoughts on that?
That's a good one. I mean, I'm not at all sure if I would be a good pick for a CEO of an incumbent, because, and I think that's part of the answer. I seem to be a quite okay-ish growth manager, entrepreneurial manager, right? But what I see from where I am is how much change management those guys have in front of them. And clearly, you know, being a growth or a manager or an entrepreneur requires very different skills from being a really good change manager. And I'm not sure, but I'm actually pretty sure I'm not a good change manager. So you shouldn't offer me the job.
Which job would you take? How would that position, you know, head of growth?
No, that's probably also not. I mean, I probably hate to be stuck in the middle of a large company. So it would need to be a company that really wants to change gears, doesn't really care about the old world, tries to build something new, and is probably, I mean, like, you know, like Mannesmann or so in the times when they went from building metal pipes to I mean, somebody who really wants to change a lot of things would probably be right. I mean, my skills would be right for this person. I mean, if you want constant changes over the next 20 years or so, I'm probably not the right guy for you.
Okay.
But I think that's a big part of the answer. I would be scared the shit out of it, being the CEO of, I don't know, Allianz AXA or so at the moment, because I see where we are as One or Lemonade or Koya or Neo Digital, and where those guys are, and how much change they have in front of them. Yes, they brag about their millions of customers, and I think that's great. But we actually see how easy it is to win customers. And we've won about 300,000 now, 400,000 now, in 2 years, basically. Lemonade has won, I mean, 1 million or more. So, I mean, we see how easy it can be to win customers. But I would be scared the shit out of thinking about how can I change manage 30,000 employees. I don't know how many employees does Allianz have in Germany. I don't know, or globally, probably 120,000 or 180,000. And those guys are, I mean, 90% of them are in the wrong jobs today, right? I mean, we don't have underwriters anymore. How many underwriters does Allianz or AXA have, right? You don't need underwriters anymore. It's machine. I mean, underwriting is answering if-then questions and coming to a decision. That's what any machine, any calculator. I mean, my mobile phone can do that better than the best underwriter in Allianz, right? So that's an ancient job. That's like riding a horse carriage or so. It's I mean, that's done, right? And you just don't see it yet. But I mean, all of your underwriters need to go. 3/4 of your pricing actuaries need to go, because it's data scientists now. It's not data. I mean, our actuaries scrape the market. We know we reverse engineered all the tariffs of all the competitors in the market. That's what an actuary needs to do, right, in the future. So get rid of 3/4 of your actuaries. Get rid of 90% of your ops people and claims people, because there's modern ways to handle this. So I'd be just scared like shit for the change management aspect of it.
Thank you. I don't know, Tom, before I try to wrap up my kind of learnings from this conversation, do you have any further comments or questions for Ollie?
Yeah, just perhaps a last one. What I find interesting is that if you talk about external benchmarking and about companies like Facebook and Google, they are never scared to pay a huge price for somebody who could, let's say, become a dangerous competitor. So if you take the Zuckerberg and others, it doesn't matter. If you can just take the whole tech scene, doesn't matter it's Google or software companies, etc. And I always question myself: is this because they are entrepreneurs and they know they were disruptors themselves, and that's why I understand what disrupting means? Because why are the incumbents, when it's cheap, not able to hedge their risk? I mean that's, especially if you talk about insurance, you should know what's how to calculate risk or to hedge your risk. And then if you talk about your whole business model, you're not able to have a huge stake or to buy those companies. So let's say, just take a very simple example, would be an interesting question for Thomas Buberle and the others, Oliver Bete and so on. We know them all. Why don't you hedge your risk of your whole company by buying in the beginning when it's not so expensive, like Zuckerberg does and Google does? What's your take on that?
I mean, they've done it, right? I mean, both companies you just mentioned, I mean, Allianz and AXA had these big acquisition years, I would guess mid of the 90s to mid of the 2000s or so, where Allianz acquired AGF and RAS and Lloyd Adriatico and whatever. I mean, there were these, Schulte-Nelle and
The Insurtechs.
Yeah, but I mean, they've done it, and that was before it was really expensive. I mean, buying a RAS today would be much more expensive than buying a RAS in the 90s. So in Italy, right, for Allianz. So they've done it. The Insurtechs, well, I think what the incumbents don't do well is to use what they get from an Insurtech and then apply it to the entire company. But because again, it will be a lot of change management, right? So I think whereas Google and Facebook take what they bought, WhatsApp or whatever, and then bring it to their business, this is very difficult for Thomas or for Ollie, right? I mean, if they buy one, let's say, I mean, we do everything digital. So again, if you use what we have in one and apply it to your entire company, then the first thing you do tomorrow is you fire 5,000 underwriters, 10,000 actuaries, and 50,000 ops people. Because that's what it means to take over what one does for the entire company in AXA or Allianz. So, I mean, they could buy us, obviously, still, not for much longer, but still they could buy us. But it wouldn't do them any. I mean, we would be a part of their company. It's like Nextable in Ergo, right? I mean, Ergo, to my knowledge, doesn't take any advantages of what Nextable has built into their core business. Because, again, what it would mean is a shitload of change management and firing people and replacing them with other people. And I think this is the difference. And I guess they realize that this is for them is very, very difficult.
You don't have to integrate it, huh?
Yeah, I think so. I would also argue that there is enough, Allianz, AXA capitalizing a bunch of VCs as LPs, having their own corporate venture debt, venture funds, etc. So I think they are hedging somewhat financially some of these assets, but I do agree it's really difficult to, and I think we will see this getting better, but it's really difficult to kind of back integrate well these things and apply them in a sensible way. So it's not just either the startup dies or it's just greenfield and goes standalone. And I think finding that, I believe, will be actually one of the things that are going to happening between an insurtech and a insurer collaboration over the next couple of years, because at least that's my unique view about the market, being the sandwich of these engagements, that it does get a lot better than it used to be 5 years ago. But yeah, I think it's just hard because of the change element aspect of it. Cool. Gentlemen, conscious of time, I will try to wrap this up, my learnings, and please challenge where I miscommunicate or missummarize. So what I've learned is product is more than what an insurer calls a product. So it's more than the terms and conditions, the legalese, the tariff. A product is really the entire, I don't like the word end to end, but let's use it. But it's where the customer or the advisor, where the user interacts with the product, how the whole quote offer bind goes, and then into what are your ongoing processes as an insurance contract lives and breathes within the insurer system, the advisory system, etc. So it's an end-to-end approach, and you did not only pay lip service to it, but within wefox, you put these things way closer together by merging product responsibilities with one and distribution responsibilities with wefox. One thing we do disagree that comparison is for dummies. That is absolutely fine. But I think you've mentioned something, that aggregation is actually not really comparing the entire market, but matching price-sensitive customers with really growth-seeking insurance annual management, meeting year-end results. And it's actually a really interesting market, and it can be, for customers to understand that, can be quite interesting, especially if you find another one next year. I think that we agree that tech allows us to create more targeted products, right? Around aggregating information, using contextual information, etc. The wefox group has two core beliefs: get advice before buying insurance. And it's, I think, rather than it, not because it's complex or simple product, but because insurance purchase is very unnatural for most people, and you can lose more than your original purchase price. And the second one is end-to-end, we'll use it again, end-to-end digital insurance. And for those of you who haven't been, we had it in the dream, not necessarily powered by the blockchain, as I've understood. We haven't touched this, but we had it in the prelude. Your competitors are anyone going for digital advice and neo insurers. So and it doesn't have to be a neo insurer just because they're new, but anyone with a high threshold of automation. You have a clear playbook on how to enter a market, own the distribution, and actually buy and grow rather than grow it yourself, because it's really hard, and then move the insurance afterwards. We've talked about direct customer. What's the main difference between a direct customer acquisition model and an advisory acquisition model? It is really around, you have very high CAC on an advisory model and are banking on the customer staying with you for a very long period of time, which is a dicey bet potentially, because you're fishing with high churn customers potentially. So it's basically in the long game they can work much better because your CAC have been basically paid off. But in your model, it's much more stable. Also because you're targeting, and I think it's low churn customers. And you would not take the job of a CEO even if they came knocking. I don't know, did I miss anything, or does this capture our conversation somewhat?
That captures very well. So that should probably be the podcast.
Yeah.
People can save a lot of time.
Is there a question we missed, or you wanted to add something, an answer on the question we didn't ask?
I think with you guys, I could discuss for hours and hours. So we could probably discuss many, many more questions, but that's up for another podcast.
Very
Perfect. Good. Ollie, Tom, thank you so much. For some, I expected that it took a little bit longer than we might have planned for. I thoroughly enjoyed it. I learned a lot. Tom and Ollie, thank you so much. And yeah, hopefully see you guys soon face to face at some point. I don't have my vaccination appointment yet, but let's see.
Yeah, we'll see. And Tom, we'll meet each other in our old restaurant once it's open again. All right, guys, thank you very much. It was a pleasure.
Thank you so much. Bye.